Listen closely. What if I told you that just 7 stocks control the fate of the entire US stock market? That's right, 7. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. Together, they make up a staggering 30% of the S&P 500's total value. Think about what that means. If you have a 401k, an index fund, or any retirement savings, about 30 cents of every dollar you own is tied up in these 7 companies. Your financial future, your retirement, your kids' college fund, all of it is riding on the performance of just 7 tech giants. And here's the frightening part. They're all showing signs that they're about to crash. Not one by one, but all at once, simultaneously. This isn't just a market dip we're talking about. It's a potential catastrophe that could reshape our financial landscape for years to come. This level of market concentration is incredibly rare, and historically it's been a massive red flag. We've only seen this twice before in modern history. In 1929, 5 dominant stocks led the market, right before it crashed by a devastating 89%. Then, in the year 2000, 10 tech stocks were at the top, just before the Nasdaq bubble burst and wiped out 78% of its value. Now here we are in 2025, with 7 stocks accounting for 30% of the market. History doesn't just rhyme. It often repeats, and the pattern we're seeing is cause for serious concern. The question isn't if a correction is coming, but how severe it will be, and whether you'll be ready when it hits. Let's break down why this is so dangerous by looking at their valuations. They're what we call insanely overvalued. Take Nvidia. Its price-to-earnings ratio, or PE, is around 67. That means investors are paying $67 for every single dollar of profit the company makes. Tesla is even more extreme, with a PE of 78, while most car companies trade at a much more reasonable 5 to 10 times their earnings. Think about that. Tesla is being valued like a tech unicorn, not a car manufacturer competing with Ford and GM. It's not just them. Amazon's PE is 48, Microsoft's is 38, and Apple's is 37, even though its growth is slowing to a crawl at just 2% a year. Even Meta and Google, with PE ratios of 29, are facing huge challenges. Meta is burning billions on the metaverse, a bet that hasn't paid off yet, and Google's core search business is under attack from AI. These numbers aren't sustainable. They rebuilt on hype and a promise of infinite growth that simply doesn't exist in the real world. The narrative driving these stocks sky high is AI. We're in the middle of a massive AI bubble, and the math just doesn't add up. Companies have spent over $1 trillion on AI infrastructure. Data centers, chips, servers, training models. But so far, that has generated only about $20 billion in revenue. That's a 50-to-1 ratio of spending to revenue. That's not a business model, it's a speculative frenzy. The market is pricing these companies as if AI will revolutionize everything overnight and generate endless profits. While AI is a transformative technology, the financial returns are nowhere near justifying these astronomical stock prices. When the reality of slow returns finally hits, the bubble will burst. And it will burst hard. So why would all 7 of these giants fall together? It comes down to 3 key reasons. First, they have the same owners. Every index fund, every 401k, every pension fund owns all 7 of them. When one starts to fall, the same large institutional investors will be forced to sell the others to rebalance and limit their losses, creating a domino effect. It's automatic, it's algorithmic, and it's unavoidable. Second, they're all riding the same narrative. The story of AI and unstoppable tech dominance has lifted all their boats. When that story breaks, when investors lose faith in the AI dream, it will sink them all together. And third, they all share the same extreme valuations, which only makes sense if you believe in perpetual, exponential growth. The moment that growth falters for even one of them, the entire premise falls apart, and investors will flee from all 7. So, what's the trigger? The most likely catalyst is Nvidia. It's the poster child of the AI boom. The company Wall Street believes can do no wrong. Look for its earnings report around May 2025. If Nvidia reports its first ever quarter of flat or even slightly negative revenue growth, the panic will begin. We could see Nvidia's stock crash 20 to 30% in a single day. That event would send shockwaves through the entire market. Within 24 hours, you could see Microsoft and Amazon drop 10%, Google 8%, and Meta 10%. Apple and Tesla, already seen as vulnerable, would fall right along with them. Within a week, all 7 could be down 20 to 30%. Within a month, the entire S&P 500 could plummet by 30%. By the end of the quarter, we could be looking at a 40% market crash. Don't believe it can happen? Let's look at history again. The 1929 crash was triggered when GE, a market leader, missed its earnings. This caused a wave of selling in the other dominant stocks, leading to an 89% market collapse that took 25 years to recover from. A full generation wiped out. The 2000 dot-com bust started when Microsoft faced an antitrust lawsuit. This event triggered mass selling across the tech sector. Cisco fell 90%, Yahoo fell 98%, and the Nasdaq didn't recover for 15 years. Today, the concentration is worse than in 1929 and 2000, and the valuations are even more extreme. A miss from Nvidia could easily be the spark that ignites a much larger and faster crash. But can't the Federal Reserve just step in and save the day like they've done before? This time it's different. Their hands are tied. They can't slash interest rates to zero because inflation is still a persistent threat. They can't print trillions of new dollars without causing that inflation to spiral out of control. The government is already drowning in $37 trillion of debt, with interest payments costing over $1 trillion a year. The Fed simply doesn't have the ammunition left to fight a downturn of this magnitude. They are trapped. And so are we. So let's map out a possible timeline. We're in the final warning stages right now. The first potential trigger could be Nvidia's earnings report in February 2025, but the more likely trigger is its May 2025 report. If that report disappoints, watch what happens. By June 2025, the S&P 500 could be down 20%. By September, it could be down 35%. By the end of 2025, we could see a 40 to 45% decline. The market might not bottom out until the first quarter of 2026, potentially dropping nearly 50% from its peak. If we see a 70% decline in these top stocks, which is not out of the question in a crash, Nvidia could go from $140 to $40, Apple from $230 to $70, Microsoft from $430 to $150. These are devastating numbers. Life-changing losses from millions of people. I'm not telling you this to scare you, but to prepare you. So what can you do right now? First, consider reducing your exposure to these magnificent 7 stocks. You can shift from market cap-weighted index funds to equal-weight funds, which spread your investment more evenly across all 500 companies in the S&P. Second, consider reducing your overall stock exposure. If you're heavily invested, maybe dial it back from 90% to 50%. Third, build up your cash position. With T-bills offering a safe 5% return, cash is not trash right now. It's a strategic asset. Fourth, look for quality companies at reasonable valuations, like those in utilities, consumer staples, and healthcare. These sectors tend to be more resilient during downturns. And most importantly, prepare yourself psychologically. The worst thing you can do is panic sell at the bottom. The crash is coming. The market concentration all but guarantees it. The only question is whether you will be prepared to survive it and seize the opportunity to buy great companies at once-in-a-generation prices. Thanks for watching, and be sure to subscribe for more updates as this story unfolds.